On the right side of the chart, when things go well, it's actually better to have a leverage in that case. But when things don't go well, actually the company with leverage is doing worse. Welcome to My Finance Teacher. And if you've ever been confused by capital structure, break-even EBIT, earnings per share, leverage, and other related issues, fear not. We're going to break it down for you into manageable pieces. So, what is capital structure? Well, capital structure is simply the split of total assets between the sources of those assets, being debt and equity. Capital structure basically shows how much leverage the company is using. Leverage is, of course, use of debt within the total assets. Let's have a look at this example. Here I've got the actual balance sheet for the largest gold mining company in the world, Newmont Corporation. And that's the balance sheet as you see for the end of March this year. Total assets, let's put this number somewhere. Total liabilities, including some contingency interest here, is going to be 17,105. And total equity, 23,958. Let's make a pie chart of this. And of course, total equity plus total debt is going to give you the same number as total assets. The left side of the balance sheet is equal to the right side of the balance sheet. So all of this total pie represents the number 41,063, which is split between equity, which accounts for 58%, and debt, which accounts for only 42% for Newmont. So this split of total assets between equity and debt is capital structure. A correct choice of capital structure is somewhat important to the management, to the top management. Because remember, the goal of top management is basically to maximize the shareholder value. And that value does depend on capital structure to some degree. Let's have a look at this capital structure represented on the horizontal axis, the percentage of debt within the company's balance sheet. And debt, generally at the beginning, when the levels of debt are relatively small, can actually improve the shareholder value, because starting to use some leverage can improve the profitability. And we'll look at that in a moment. But too much debt can also be a little bit too risky. If things don't go as planned, then the company might lose much more value than it would have without debt. So going into too much debt is not preferred, as the firm value declines. Let's have this blue line for firm value. In that case, this amount of debt in percentages as of total assets is probably a good choice, as it maximizes shareholder value. At the same time, if you read some papers on capital structure, you will see that maximizing shareholder value is also somewhat similar to minimizing the weighted average cost of capital by choosing the correct percentage of debt within the total assets. We've talked about the weighted average cost of capital in a recent video, so you can review that. While one extra bit we are learning about the weighted average cost of capital right here is that it generally moves in the opposite direction with the firm value along the capital structure on the horizontal axis. Now though, let's see how capital structure affects our profitability, how using some amount of leverage, perhaps not too much leverage, so using some amount of leverage over here at low levels of percentage of debt within the total assets, can actually be somewhat beneficial if the business is doing well. So let's have a look at similar companies, one with no leverage, where the total assets, let's say market value of total assets is 8 million. Let's say it has no debt, all of the assets are actually funded by company's equity. Share price is, let's say, $20, and let's say they have 400,000 shares outstanding, so same as the market value of all the assets. And let's say for simplicity, the tax rate is 0%. In the other corner, let's have another company with some debt, with some leverage. Same size of the company, the market value of total assets is, let's say, 8 million. Half of that is coming from equity, half of that is coming from debt. Same share price, a less number of shares outstanding, which would be equal to the total value of all the equity in the company. And the same tax rate, for simplicity, is 0%. So in this example, let's see what happens to the profitability from investing into the company. Let's have a look at the return on equity and the earnings per share to the company's investors, to the company's shareholders. What happens to their return on investment as two companies basically face the same situation, either a recession or normal economic growth or a boom, in which case they make similar earnings before interest and tax. $500,000 in case of a recession, 1 million in case of a normal economic growth, and 1.5 million in case of a boom. Net income profits with zero tax is simply going to be EBIT minus the interest minus the tax, which is zero in this case. So for the company with no leverage, net income is same as EBIT. Oh, I forgot to mention, let's say interest is going to be equal to, say, 10%. So 10% of debt is our interest, and I'm going to use a fixed reference here. And again, with no taxes, net income or profit is simply EBIT minus interest minus zero tax. So looking at the net income, looking at the profits, of course, the profits for the company with leverage are smaller. However, this smaller amount of profit has to be divided between smaller number of shareholders, smaller number of equity holders, meaning that each of them have a relatively better return. Let's look at those returns. Return on equity is, of course, net income divided by total equity. Fix the reference and copy the formula, which gives you the return on equity to the shareholders in case of no leverage. And of course, earnings per share is net income over the number of shares outstanding. Fix the reference and copy the formula. That's earnings per share in dollars. Let's do the same for the company with leverage. And what do we see from this comparison? What we see is leverage can be bad when things don't go according to plan. As we see over here, if things go bad, if the recession hits and the business doesn't do well, then the return on investment to the shareholders is worse than the return on investment to the shareholders without leverage. So the red numbers over here are in favor of no leverage. But when things go well, when things go according to plan, or even better, the return on investment to the shareholders with leverage is actually better than the return on investment to the shareholders without leverage. Let's color that green, showing that yes, sometimes moderate amount of leverage can be good somewhere over here before firm value drops when the company has simply too much debt, which increases the risks. Now let's throw in the tax rate over here of, let's say, 20%, in which case we simply adjust the formulas for net income, for profits, by adding the tax payment over here. Multiply the earnings before tax by 1 minus the tax rate. Let's copy the formula and do the same for the company with leverage. Change the calculation for net income, for profits, by multiplying that times 1 minus the tax rate. As you see, even then, when things go according to plan, having a moderate amount of leverage is pretty good. In this case, perhaps 50% is too much, but it depends on the industry. More stable industries, such as utilities, can actually afford to have more debt and more leverage. But of course, when things don't go according to plan, the company without leverage is going to do better. Actually, we can show this situation on a chart. Let's do that next. Let's look at this chart where I'm going to place earnings per share on the vertical axis and earnings before interest and tax, EBIT, on the horizontal axis. Let's say it's in thousands. So this represents $500,000. This next number represents 1 million and 1.5 million. Let's color code the corners. Blue is going to be no leverage, and red is the corner with leverage. So let's place the dots over here for the first case of no leverage. When EBIT is $500,000, the earnings per share is $1. So that's a point somewhere there. When EBIT is 1 million, earnings per share are around $2, a point somewhere there. And $3 for EBIT of 1.5 million, a point somewhere there. And the line connecting these points shows you the relationship between earnings per share and earnings before interest and tax in blue color for the company that does not have any leverage. Now let's see what happens to the company with leverage. When EBIT is $500,000, earnings per share is 0.4, a point somewhere over there. At 1 million, EBIT is 2.4, a point somewhere over here. And at 1.5 million EBIT, earnings per share is 4.4, a point somewhere over here. Now connecting these red dots shows you the relationship between earnings per share and earnings before interest and tax in red color for the company with leverage. So what do we see over here when we compare the red line with the blue line? What we see is that on the right side of the chart, when things go well, when the earnings before interest and tax are high, the red line is above the blue line. So it's actually better to have a leverage in that case. But when things don't go well, on the left-hand side of the chart, when EBIT is around $500,000 or so, the red line is below the blue line. So actually the company with leverage is doing worse when things are not going well. And the next point of interest over here is this intersection between these two lines. At which level of earnings before interest and tax do both of these companies with and without leverage perform equally well? This amount of EBIT, this value of EBIT is called break-even EBIT. And for the last thing for this video, let's see how do we calculate this break-even EBIT. Perhaps that might help top managers to decide whether they want to take on leverage or not. And basically to calculate EBIT, I have to compare this vertical axis earnings per share and find where the value intersects, basically find an equality, find the equilibrium. The blue line, earnings per share, is represented by this equation, which is EBIT minus interest, there is no interest over here, minus tax. We subtract the tax by multiplying that by 1 minus the tax rate. And all of that divided by the number of shares outstanding. This is basically the equation for the blue line. To find the intersection with the red line, to find the equilibrium, I have to equate this ratio to the formula for the red line, which is also earnings per share, but there is interest. So earnings per share in that case is going to be earnings before interest and tax minus interest payments and minus tax. We can again subtract tax by multiplying the earnings before tax by 1 minus the tax rate. That gives you net income, that gives you profits. And then we divide all of this by the number of shares outstanding. Now let's throw in the numbers from our example. And in this case, remember, EBIT is the variable that we want to find. The X that we want to find is the EBIT because that's what we are wondering about. At which level of EBIT do these earnings per share lines intersect? So let's throw in the numbers here. And we get an equation like this. EBIT times 1 minus the tax rate. In our example, that's 0.8 divided by the number of shares outstanding. On the left-hand side, in the blue corner, we have the company with no leverage with its 400,000 shares outstanding. And on the right-hand side, in the red corner, we have EBIT minus the interest of 400,000. Remember, the company with debt has to pay this same interest, whatever happens to the economy, times 1 minus tax rate, which is 80%, divided by the number of shares outstanding, which is 200,000 for the company with leverage. If you rearrange this equation a little bit, correct me if I'm wrong, I think this is what you're going to get after a bit of rearranging. And lastly, if you rearrange this a little bit further, I think you will get a break-even EBIT of 800,000. So I hope it's been useful to learn a little about capital structure with some examples from the largest gold mining company in the world and looking at how leverage affects investment performance for shareholders, as well as learning how to find the break-even earnings before interest and tax. This can be useful because if the top managers expect EBIT much higher than this number, then leverage can actually make the situation even more attractive. If, on the other hand, there is a high risk that EBIT will turn out to be less than this number, then perhaps the managers should not take on any leverage. And that is all for now. Bye-bye.